All right. Welcome to our
Hey, Jamie. Hey, Lisa. How are you doing?
all right. Welcome to our latest Convergent Happy Hour with Scott Limoli and Ryan Jorgensen Limoli, CPA firm, joining us tonight. So we've got a good presentation. We're going to cover the market updates, so what's been happening in the markets over the last few weeks, as well as updates on all of the tax changes that have come out of the CARES Act and other things related to the coronavirus in the last few weeks. So I'm going to share my screen here and pop this into presentation mode. I'm going to come in and out of this just as we cover various things through the presentation. All right, so for many of you, you know me already. My name is Homer Smith. I'm a financial advisor here in Gig Harbor, Washington. I've been in the business for about 18 years. The last 10 of those here in Gig Harbor focus on successful families and business owners. And really, I guess the way I describe what I do is really helping quiet all the noise that's going on out there and help you really focus on what's most important to you. And a big part of my practice is specifically working with business owners and helping them kind of plan for that growth to exit of their business. So with me today, a special guest on the Konvergent Happy Hour is Scott Limoli. So Scott, I'll let you introduce yourself as well.
Hey, thanks, Homer. Can you hear me okay?
Yep.
Okay, cool. Yeah, Homer and I have known each other now for, gosh, probably over 5 years now. I'm a CPA here in Gig Harbor, and I know some of you guys are clients of ours. My emphasis is basically in the small business area. I do a lot of tax and consulting work for small business owners. And so we do a lot of work with, succession planning, helping people come up with exit strategies, looking at acquisitions and things like that. Our firm is, we're a large local firm. Our main office is here in Gig Harbor. Prior to COVID, we used to have about 22 people working in the office. Now it's just kind of me here by myself. But yeah, we're a large local firm, and our philosophy is really just, we're here for our clients and getting to know them, and just part of their professional advisor team, which includes folks like Homer and their business attorneys. And really, the last couple of months, it's been interesting for me coming out of tax season. So much of what we've been doing is just, being here for our business owners and listening and giving them guidance on some of these new laws and things that we'll talk about tonight. But it's been really crazy how that lined up with the tax season, and that so much of what we have done, my daily routine has not just been helping people with their taxes. It's been more all these other curveballs and things that come at us every morning from the news and legislation and all this kind of stuff. So looking forward to sharing with you guys a little bit about what we've learned in the last couple of weeks, and just some new things that were buried in those big tax bills that we had, in late March and in April. So hopefully we can have some good Q&A and go through anything that you guys maybe have questions on.
Cool. And as you know, Scott and I both have our coronavirus beards going, although Scott has his more often than I do, but it's been a little bit more often for me during this lockdown here.
Yeah, I've been putting a lot of stuff in my hair, man. It's been almost 2 months.
Yeah, you gotta be brave like me and decide to buzz your own hair once you get to a certain point. Yeah. All right. So what we're going to cover today is I'm going to do a quick market update. I'm sure you guys get inundated with market news all the time, given what we've been going through. But pretty much every week I'm giving up the latest on what's been going on in the markets and answering any questions that you might have specifically about what we're seeing out there. And then we'll cover some of the changes we've seen in the federal tax filing deadlines, as well as some of the key provisions for individuals on that, as well as we'll dive a little bit deeper into the CARES Act specifically, and cover probably the one that's been the most notable, which is the Paycheck Protection Program. But we'll also cover some other miscellaneous topics on that as well. And then we'll cover a lot more on the individual relief pieces that came out of the CARES Act on retirement account changes and some miscellaneous individual tax provisions. And then Scott, in particular, on the tax side, will be available for any questions you all might have from that. So I'm going to cover initially a market update. So I'm going to pull up some slides separate here for you guys. So I'm going to start kind of looking back a little bit. I know a few of you have been on these presentations for the last couple of weeks if you're my clients, but I wanted to kind of start with a big picture approach to what we've seen in the last couple of months, because it's been quite a roller coaster ride. So in February, late February into early March, we saw one of the most severe market declines in the history of the market, to the effect that we had the quickest amount of time from market high to bear market territory. So a drop of at least 20 percentage points from the all-time high. It took only 16 trading days to accomplish that, which if you think about, what we've seen over the last number of years, October 2007 was the last big drop that we started from. It took 274 trading days to accomplish that same feat. So a very severe drop in the markets in that very, very short amount of time. Since then, we've kind of seen the opposite of that. So late March through April, we saw some of the best markets in the history of the market. So April of 2020 was one of the top 3 months in the market since World War II. And really a lot of the reasons for that market rebound was really 2 things. One was the Fed and the Treasury committing massive amounts of dollars in stimulus, whether it was things like the Paycheck Protection Program, which we'll cover more, whether it was some of the direct payments to individuals, and whether it was additional unemployment benefits. There was a lot of things that came out in that time. And then secondarily, the initial fear of the virus and the economy shutting down was what really drove the markets down in March. And then since then, there's been some level of optimism that we'll be opening the markets back up. And so we've seen the market somewhat recover from that in the last 6 weeks or so. So that's cause for optimism. It's nice to see the markets bounce back. What I really, focus on, and again, it might be a broken record for a lot of the clients of mine on this call, but in spite of the markets doing well, I think there's a lot of reasons for, concern out there and being cautious. And the first one here is the GDP number that was reported last week. So the Q1 GDP print was a negative 4.8%, so a contraction of the economy by 5%. And as I covered on my video on Tuesday, that if you guys were able to see our video on the website, interestingly enough, March is only 1/9 of the formula for GDP calculations so basically the last month of the quarter is only 1/9 of the calculation. So the first month in the quarter is the heaviest weight of that. So really the economy was shut down for about 2.5 weeks, 3 weeks, depending on what state you were in. And that 2 or 3 week period still ended up causing our economy to drop by 5% over the course of the quarter. So if you think about it for this coming quarter, being that April is going to be the most heavily weighted month of Q2 GDP, a lot of the estimates out there right now are between 20, 30%, and some are out even worse than that. So the level of contraction in terms of the negative GDP growth for Q2. So while it's nice to see the market bounce, there's some optimism that the economy will be opening back up. There's obviously a lot of ground that needs to be made up based on where we see GDP right now. This is another chart that is pretty interesting to me, that kind of explains a little bit what we've seen in the last.
Hey, Homer, I can't see your screen. Are you, am I doing something wrong?
I don't know. Can everyone else see the screen? Can I see the charts that are popping up?
Yes, I can.
All right.
Oh, I got it.
Okay.
Thanks.
Yeah. So this is a chart of basically the green line is the earnings estimates for the S&P 500, and then the blue kind of blob is the return of the S&P 500. And what you see is, for the most part, over time, corporate earnings drive the performance of the stock market. It's not the economy; it's really corporate earnings that drive the stock market. And what we've seen in the last month is this major divergence from corporate earnings and the stock market. So starting in early April, as S&P 500 companies started coming out with their earnings and providing guidance, the earnings expectations for the S&P for the year have come down between 15 and 20% or so, and the market has bounced back, significantly in that time. And so basically how expensive the market is, the price to earnings ratio is now more expensive. Basically, the market is priced higher than it was in February before we started seeing all the drops related to the coronavirus. And then, a lot of headlines lately, and the latest number came out this morning. So we had about 3.1 million new claims for unemployment this morning come out. So over the last 7 weeks, we've had over 33 million claims for unemployment. I saw a chart off the top of my head, I can't remember the total number, but from a week ago or so, the continuing claims were still over 20 million. So new claims is a big deal. So how many new claims have there been each week? As important, or really more important, is how many of those people are having to extend unemployment, and that number is staying really high as well. And so tomorrow we'll get the big number on unemployment, which will give us a good indication of where all that is standing. So a lot of people out of work right now, and we've actually, in the last 7 weeks, we've lost significantly more jobs in just 7 weeks than were created from the bottom of the last crisis in 08-09 till now. So just a lot of concerning data there. This is a chart on consumer spending. So on the bottom part, you see March numbers. And again, given that only about half the month was shut down, we saw this massive drop in consumer spending, which clearly is a big outlier that even if you go back in all the months in history, we didn't see drops like that. This is a quick chart on auto sales. So just a big indicator on what consumers are thinking right now. This is March numbers. So we haven't had April numbers just yet. So in March, we saw the numbers drop from close to 17 million down below 9 million. So about a 50% drop in auto sales, again, with only the economy shut down for about the last 2 weeks of March. And then this one, is kind of more forward-looking. So this is a survey that's done looking forward to what are people's expectations on their willingness to book travel, and this one specifically into a hotel or resort at some point in the next 6 months. And as you see, between the not likely and so this is the extremely unlikely, 52%, and unlikely, 15%. So close to 70%, so 67% of those surveys said they're either unlikely or extremely unlikely to book a hotel room. And only 18% said they are either likely or extremely likely. And if we go to the 5-week average, which is over here on the right, you'll see we've been actually dropping a little bit over the last few weeks in terms of people's likelihood of booking a hotel room at some point in the next 6 months. So it just gives us, again, a little bit of a cause of concern of kind of where is this economy heading? We've heard a lot about this pent-up demand, that as soon as the economy opens up, there's all this pent-up demand that's just going to go right back out and drive the economy higher. And we just have a little bit of a reason to believe that it might take a bit longer. Another area that we have a little bit of concern about is not so much liquidity, because the Fed really has stepped up along with the Treasury in providing liquidity to the markets, but really it's solvency. And that's the amount of bankruptcy filings that we see. And historically, that level of bankruptcy filings pretty closely correlates to unemployment. And we've seen this massive spike in unemployment over the last 7 weeks. And so we're starting to see some of that bankruptcy filing coming through. Neiman Marcus, I think, was the big one today that we saw come through. J. Crew. So some other retailers are the big names we're hearing about. So the level of bankruptcies are starting to increase as well. And then another indicator of potential bankruptcies to come is the commercial rent likelihood of paying. And so this is a graph of a survey of commercial rent payers for May and their likelihood of paying for their lease or their rent in May. And between the 50% and below to zero, it's a large majority are planning to pay 50% or less on their rent for the month of May, which if we start kind of extrapolating that out, that impacts the landlords, who then also might be having to pay a mortgage on that property, and then that impacts the banks. And so it just kind of creates this kind of snowball effect in the economy over time. So again, there's a lot of optimism, and economies are beginning to open up, and we're hoping that this economy really gets back going again. But we're just a little bit concerned about all of these various details. So while the required disclosure screen is up that I expect all of you to read in full, the narrative right now, as I mentioned, is the economy is opening up, everything's going to be okay, all this pent up demand. I like to kind of go back to a scenario that we saw back in 2008. So in almost similar time frame too. So March of 2008 was when Bear Stearns, the first big bank, collapsed, and they were really over levered, and they got caught up in the cycle that we were in. But once they collapsed, the narrative was kind of like they were the one bad seed, and that everything else was okay. And the market bounced back pretty heavily in the next couple of months after that. And it wasn't really until 4, 5, 6 months later that all of the data kept coming out and really proving how bad things were. And while, you know, I'm obviously not predicting that's going to be the case this time, that's the concern that we have, and that we could see something like that again. So while it is nice to see the market bounce, and we do want to see the economy just open back up again, we're still just cautious because we want to make sure that we're not just setting ourselves up for something like we saw back in 2008. So that is the end of the market presentation. Any questions from the crowd? You can click on your Zoom. You can click the unmute if you've got a specific question that you want to ask on anything related to the markets or the economy.
Yes, question, Homer, Bill Roster here. I didn't see any graphs. Did everyone else get a view of the graphs?
Yeah, we got it here.
Yeah, I could see the graphs.
Yeah, I fixed it. I think I was in maximize mode or something, and I clicked on it, and it was able to see it.
Oh, sorry.
It can be difficult sometimes on an iPad or a phone.
And that's what I'm using. Okay.
Yeah.
I guess we just, okay.
Well, the good news, if you
you.
want to see all the pretty charts, you can check the recording that we'll have up on the website tomorrow. So you'll be able to see.
Okay,
see all
thanks.
that. Yeah, sorry about that, guys.
This is Dell here. Don't you think we've just seen the tip of the iceberg on these bankruptcies?
Yes.
I mean, it's going to be a snowball effect because so many undercapitalized companies just can't stand the strain, if you will.
That's my opinion, and you know, obviously, got to be careful on these types of meetings. Yeah, that's my opinion. I think that's the liquidity versus solvency is a big. I think people get confused on the fact that the Fed is providing a lot of funding to the markets, and businesses are getting these paycheck protection loans, but that doesn't create revenue. And without revenue, businesses can't survive over the long run. And that's the challenge we're facing, is that you know, we can get a couple months of funding to pay employees and pay rent, but it's not replacing the revenue that's lost, that now is gone forever for many of these businesses. And you see some of the surveys out there on restaurants and their likelihood of being able to open back up again the longer this goes on. And you know, all of them have, you know, lease payments. Those commercial real estate owners, the landlords, have mortgage payments. So it's what I keep, like the reference I use, you know, the tip of the iceberg is a good one. The other one I use is I believe we're still in just the first or second inning of this game, and there's a lot more to come, you know, on how this is going to play out in the coming months.
Hey, Homer, this is Larry. I was talking to a friend of mine in Tacoma, and he owns some commercial real estate, and Mod Pizza, who have, I don't know how many hundreds of locations throughout the country. One of his tenants is Mod Pizza, and they just sent out a letter to all their landlords saying we're not paying rent for a while.
Yeah.
And just kind of, so to your point about the snowball effect, that some of the national retailers, the larger firms, are somewhat playing hardball and just telling landlords, you know, we're not going to pay for now. So I thought that was interesting.
Yeah.
The small guys are stuck trying to pay, but the big guys can kind of show their muscle.
Yeah.
So Homer, as a wealth manager, there's always an opportunity in almost every situation, whichever way the market is blowing.
Yes.
What would be your top 3 recommendations in the midst of this level of turmoil and uncertainty?
Yeah. So again, due to our regulatory environment, I got to be careful making specific recommendations because everybody's situation is different, right?
I got a drink in my hand. It's okay.
Yeah. So, you know, So I mean, what we're doing right now is we're being cautious with our clients and our money. So areas that I think are interesting areas, you know, not specific recommendations, but areas that we find pretty interesting right now, given where things might go, is treasuries. You know, on the very conservative side, you know, if you think the market and the economy might be going, you know, to a negative spot further than we are today. The likelihood in the short run is rates might fall given that. And so you can actually get a decent return just being conservative in treasury bonds in the short run. We've seen some opportunities in technology. You know, the one area that's held up the best, the NASDAQ today turned positive for the year. You know, people are buying online. Companies like Zoom and Microsoft with their online platforms for meetings like this have been doing very well. And then the other area that I think is an interesting area for people who have the risk tolerance is precious metals. So areas like gold and even in gold miners are something to consider. So I've never been a really big gold investor in my career and haven't really put a lot of client money into gold over time. But you know, as I've been researching it, it's an area that I think is interesting to be considering right now. Again, not a recommendation. Everybody's client situation is different. But it is an area that I think people should be at least looking at.
So you wouldn't be going and buying VXX puts or yeah. Right.
Yeah, no, that would not be a normal recommendation. But obviously, you know, every individual client situation is different, and you know, for clients that are more aggressive, you know, we have, you know, different areas that we might go into, but in general, you know, I think caution is kind of our word of the day. But the same thing, as we talk to clients in individual meetings, we always discuss with each of them that, you know, there are always opportunities in times like this, and if they are more aggressive, there's always things we can talk about individually to take advantage of it. Hopefully that didn't get me in trouble with the regulators.
Hopefully there aren't any regulators on the call, so
We'll just blame, you can blame it all on Scott's friend, Jamie.
That's right. It's all good. It's all good. I'm used to it.
Hey Homer, what level of cash holdings or short term are you looking, or most clients, you know, looking to hold right now? Are you?
Yeah, again, that's such a tough one.
That's another tizy one, but
yeah, it's such a client by client conversation. You know, some clients that were more conservative that we went more cash on. You know, I get the occasional call like, hey, why aren't we getting more of this upside in the market? You know, and you know, the clients that remained a bit more aggressive through this, you know, are probably, you know, happy that they weren't more in cash right now. But it really, that the cash question really is a client by client conversation. That's a tough one. I do think it makes sense, you know, generally speaking, in volatile markets, and especially, you know, based on where we're kind of thinking things might be headed, cash is not going to be a bad thing, I think, in the near future, to have some powder dry, you know, if we see, you know, something more like 2008. All right, before you all get me in any more trouble, we are going to
trouble.
We are going to turn it over to Scott. Let me put this full slideshow back up here for you all. Oops, didn't mean to do that one. All right, so Scott, I'm going to turn it over to you to talk about some of the specific tax changes that we've seen related to the mostly to the CARES Act, but just anything related to the coronavirus situation we found ourselves in.
Yeah, and on the filing side, this was interesting when things first started to heat up with the whole coronavirus. You know, we were concerned just as a CPA firm. It's like, what are we going to do? All of a sudden, we have to send all of our workforce home, and how are we going to meet the deadlines that you know, the federal government has for filings? So probably the biggest thing they did very early on to help us out was they extended the federal due dates. So most people have got this figured out by now, but basically without filing any kind of extension form or anything, the filing deadline has been extended from April 15th to July 15th, which was a huge deal because it also applies to estimated tax payments, your first quarter payments, which are typically due at the same time when you file your returns. And then we received some additional information that said, oh, you know what? We're going to put the Q2 payments in there that would normally be due in June and let those go all the way to July 15th. So that was a huge deal because a lot of our clients are having some cash flow concerns right now. And to not have to worry about those payments due from last year, as well as the payments due for this year, was a significant relief. The big thing I've been trying to emphasize with folks, though, is that this is a deferment, not a forgiveness. You still owe your taxes from last year. The only other time in my career that I've ever seen an extension of the deadline was in the 2001. For those of you guys that have lived in Washington for a while, there was an earthquake and we got a couple weeks extension back then. But other than that, things are pretty serious when they're extending the payment deadlines for federal tax returns. This also applies to corporations. So what we've told people is we've said, hey, if a lot of our clients filed early just because we were working on the things in February and March before all of this happened. We've said, if you're expecting a refund, take it. Who knows what's going to happen in the next couple of months. So we were recommending people file electronically. And as the slide says there, we were seeing clients get their money back within a couple of weeks in a lot of cases. So that was very helpful for some of our business owners that were strapped for cash. But just keep in mind, there's no penalties or interest for unpaid balances. If you pay everything on July 15th, you're good to go. But anything beyond that, you're going to have interest and penalty calculations to deal with. So that's a little up in the air. We filed some returns. I don't know how the IRS was able to get their systems updated to handle all of these new deadlines, but we haven't seen any notices come through. My understanding is that for folks that live outside the United States is that they would fall under the old rules of just having a filing deadline as of June 15th, like the slide said, or if you're in the military. But one of the unusual things that they also wrapped into this legislation was the IRA contribution deadline. Typically has been April 15th for just regular IRAs. They punted that out to July 15th. Which is nice because some of our clients didn't have an opportunity to get that stuff figured out before April 15th. And it also, that applies to health savings accounts. We've had a few people ask about HSAs and IRAs. And so, we've seen some examples where when you look at phase outs and things like that, that by making the IRA contribution, you can potentially save more than just the marginal tax rate if there's credits and things factoring into the return. So that's a pretty neat thing that people should consider if they're not filed and they're eligible to do a regular IRA contribution.
All right. So next up, we'll jump into a bit of the business related relief from the CARES Act, and Scott and I will kind of go back and forth as we cover some of this stuff. So on the Paycheck Protection Program, the most important thing they were trying to at least put out there in the news was that, hey, we understand that Main Street needs as much help, if not more, than Wall Street needed. And so as they were battling back and forth in Congress on what to pass, they ultimately came up as one of the main things they passed was this Paycheck Protection Program. So primarily designed for businesses and nonprofits with fewer than 500 employees. But as you guys probably saw in the news, there were some exemptions made for even public companies that had subsidiaries that, restaurants individually that might have less than 500 employees specifically. But primarily it was designed for small businesses. And basically all you had to do was certify that the loan was necessary, that that's, at some point in the future or now that you had concerns that the coronavirus is impacting your business in a negative way. And there were limitations that if you took funds from the Paycheck Protection Program, that you couldn't take funds from other programs like the emergency as EIDL and use it for the same thing. So there's other programs you could actually access. You couldn't just use them for the same things like payroll and rent that you could use the PPA for or the PPP for. So effectively, it applies from a period of February 15th to June 30th. Maximum loan size was 10 million. It was intended, as I mentioned, to cover payroll taxes, health insurance, premiums and interest, mortgage payments and rent, and utilities. And initially, there was approved about 349 billion in loans that were approved, and the funding for that basically was used up within about 2 to 3 weeks. And as you guys, as I mentioned, as the news kind of started coming out about who was getting access to the funds, there were some small businesses that definitely got access, but there were large chunks of the funds that were getting used up by much larger businesses that were using multiple tax IDs. And, you know, it was all legal under the rules, but may have not been what was intended. And so the funds got used up very quickly. So another 310 billion was added here just about a month ago in April. And those loans started going live a couple of weeks ago. And the good news, I did a blog post on this just recently, but the good news on that is the loan size has come down quite a bit on the recent PPP loans. And so basically what that's saying is more smaller businesses are actually getting access to those loans. So nice thing, the loans are 100% guaranteed by the US government as long as they're used in a specified period of time. No fees to get the loan set up. And that the challenge though is you have to use them within a very specified time period. You have to use up the loan proceeds by June 30th. If you're not able to get all of the loan forgiven, which we'll cover coming up, they do have very favorable terms in terms of extending that loan and turning it into a term loan from there. So with that, I'll turn it back over to Scott for more of the tax implications of some of this.
Yeah, and just as a follow-up on the PPP loans, you know, that's probably my biggest thing every day. I come into 10 or 15 emails about what's happened in the last 24 hours on those.
Yep.
And a couple of resources for folks that are curious, just like where do I go to figure out what's going on with these loans? The CPA Association, the American Institute of Certified Public Accountants, has a really good FAQ on the PPP loans. It's updated, it's almost every day. And they've got a very nice, concise Q&A section in there, broken out by, you know, questions from self-employed people to business owners, and there's a whole section on forgiveness. So I really encourage you, if you have questions, because this is a very fluid thing right now, checking out the AICPA site. If you have any concerns about if you applied for PPP or received PPP. I noticed today, it was interesting, I had probably 4 emails from clients that bank with various banks in the Puget Sound region. And something must have come out that all the banks are subscribing to now that's provided them some additional data points to send out to their customers. And I received I got one from Columbia Bank, Wells Fargo, and a local bank in Tacoma that all had information about how to interpret what you need to do to spend the money during the 8 weeks after you've been awarded it. So that's the big concern right now, is people just don't know like what qualifies, what doesn't qualify. And the banks have been so focused on getting this money out to everybody, they didn't really understand what was going to count towards the forgiveness calculations or have the formulas available. And we're starting to see that come out today. And I anticipate in the next couple of weeks, we'll see a bunch more. And as far as I know, the PPP funding is still going. We've had a few people apply within the last day or so. So if you haven't done.
What was your experience in the first round versus the second round, if you've had enough experience with clients going through it in terms of, you know, we heard a lot, especially with the first round, the bigger banks struggling to help smaller businesses?
Yeah, it was a disorganized mess, to be honest. You know, I watched, because I have a unique perspective on this, because I've got big clients and little tiny clients, and everybody banks from everyone from Wells Fargo to little local banks. And it was a crazy process. And there were a few of the local lenders that weren't prepared, and everybody went at it a little differently. And it was like one of those things where you're in line at the grocery store, and my wife and I always argue about, do we change lines or do we stay in our line? because that person looks like they're moving a little faster than we are. Should I move over here? And then, oh crap, this person has a debit card that doesn't work, and then we're stuck back at the end. And it was insane, and nobody really understood the process. And so the first round was a mess, and I definitely believe there'll be some issues that surface that some of the big banks push through their big existing customers ahead of the other people, which you're starting to see in the news now a little bit.
Yeah, and that was my experience too with my business owner clients. The bigger ones that had really good business relationships, and most of them had more community banks or regional banks.
Yeah.
But a lot of the independent contractors, self-employed, that might have just had an individual checking account with their, with a Wells Fargo, with a Chase, a Bank of America, basically were left out of the process because they didn't have a lending relationship necessarily with the bank.
Yeah, it was a tough spot. The second round has been way different though. I don't know if there's just more resources or people have gotten smarter about it, because like I said, it appears to still be open. I have people calling that say they've just been funded. And the weird thing now is that you're getting funding after, most of the provisions were written assuming the money was all dispersed by April 30th. And now we're getting funds that are hitting bank accounts on May 6th and May 7th. And so they don't have a full 2 months to spend the money now until June 30th. So we're going to see some pretty significant revisions and interpretations on all of this stuff, on what's taxable and forgiven and all that. But yeah, interesting.
Yeah, maybe specifically, I can't remember if it got into the slides or not, but maybe touch on some of the more recent news on the taxability of expenses related to what is forgiven.
Yeah, and that's a good point. The big buzz, there was a lot of information pushed out at the end of last week about, so, there's an IRS, ruling interpretation on how the money's going to work. If it's forgiven, do we also get to deduct the expenses? So, for example, I have a company, I get $100,000 of PPP money. I turn around and pass that to my people. I keep my workforce employed. So I turn around and spend that $100,000 on payroll costs, and it's all good. We do everything we need to, and it's forgiven. There was a misunderstanding where some people were thinking that you get free money, you spend it on the payroll, and then you also on top of that, you get a deduction for $100,000, which in my mind that doesn't seem real logical, but there's been some discussion that people were feeling like, oh, that doesn't make sense. We should be able to expense the payroll costs that we paid, even though we got $100,000 to pay those costs. And it's weird because the AICPA, which is our trade association for CPAs, is actually lobbying to say that we should get the deduction. So if you pass the PPP money on to the employees like you should, that maybe you'd actually get the benefit, of an additional tax write-off. So you could actually be, if you're in a 30% bracket, you'd be.
That's kind of the idea, right? Is to give that extra benefit, right? If you really want to help small business owners,
you'd be 30,000 to the good. Yeah. So that's a tough one right now. They're still kind of going round and round on that. My guess is, because we see this with RMD credits and things like that, you don't generally get to take tax-free money and convert it to a deduction. That's just kind of how the IRS works. But we'll see. And who knows? It's crazy times. Who would have thought we would have had a 3 trillion invested into these loans? So,
I think that's the big point of all this too, right? There's so much more still to come on how this is going to play out, and whether Congress comes back and changes, makes some specific change to allow for those deductions or not.
Yeah, the big thing that people should be, very fortunate is the inflow. If you got the money and you use it for what it was intended to be used for, you're not going to have to pick it up as income. So that's a huge benefit. We'll see what goes forward on the deductions.
Cool. You want to touch on any of these? Obviously, people can read what's on.
On the business provisions, a couple of things in here that were interesting. Some of the interest limitations for larger businesses. They're just, all these things are basically making it more, tax friendly. They're fixing some of the phase outs on charitable deductions and tweaking the depreciation that we're allowed to take on qualified improvement property. And the big thing in this slide, and I think in the next one, Homer, is they're really being conscious about net operating loss deductions. And that's a provision in the code that says, hey, if we have a terrible year now and we're running losses, can we go back and capture taxes that were paid in previous tax years? So if I have a horrible 2020 and I'm running losses, can I take those losses and carry them back and get money that I paid when I had, you know, a robust 2018 or 19 tax year? And when they changed a lot of the laws in this past 2 years of tax legislation, they took away the NOL provisions. So this is a big deal because people that are having, you know, income hits this year can now go back to the way the rules used to be and potentially get some tax refunds off of prior year income. So that's a good thing for business.
Cool. All right, so we'll switch gears here and kind of talk about more of the individual, you know, non-business owner provisions that came out of the CARES Act as well. So I'll start on some of the retirement account changes. So one of the big ones was related to distributions from retirement plans and allowing for the ability to access your funds in your retirement account without penalty for issues related to the coronavirus itself. So if you became sick or had, you know, others that you're caring for be sick from the coronavirus, it increased the amount of reasons that you could access your retirement plans without any penalties from that, which is a big deal since a lot of people, their primary savings might be through their retirement plan. It also allowed for some special provisions, which were, you know, in addition to hardship withdrawals and things that you would need to access in a tough situation, they increased the ability to get access to your retirement plans. Number one, increasing loan amounts from $50,000, which has typically been the max, to $100,000 of a loan from your 401k. And then also increased the ability, or created the ability, for you to take a withdrawal from your 401k of $100,000 if you're not typically eligible. So if you're not 59 and a half, you're able to take out $100,000, and it provides a long time period over which you can pay the taxes on that withdrawal and or put the money back over a longer period of time than typical. So historically, if you did a distribution from your IRA, you had 60 days to put the money back in without having a tax liability as a qualified rollover. This allows you to actually take those funds out and pay that money back to your retirement plan over a much longer period of time, and or pay those taxes over a much longer period of time. So giving, again, a lot of relief and access to retirement plans for those purposes. So kind of speaking ahead a little bit here on that. So one other thing, and Scott and I were talking back and forth on this a little bit as we were preparing for this, is the RMD waiver. So they already had made some changes to RMDs coming into this year, where they extended the age required distributions from 70 and a half to 72. And then they made an additional provision that you could waive your RMD completely this year if you were required to take it. The challenge was there's many people that begin to take those RMDs early in the year. And so they might, as soon as they get the notice in the mail of what their required minimum distribution is, they take it in January or take it in February. We're still not sure yet, based on the information that we have, whether you can put it back. So if you did want to avoid taking that income and taking that tax for this year, we're still not sure yet whether you'll be able to put it back in and avoid the tax. So we're still kind of waiting on additional information. So kind of same thing with the business owner provisions. There's a lot of things still yet to come, and we're not really sure exactly how it's going to play out. Same thing with the RMDs. If you were early and you already took it, and you might want to put it back and avoid that tax for this year, we still have to wait until we get further guidance on where that might be. Right,
yeah, and this section, Homer, was kind of connecting a little bit more to just some of the random miscellaneous individual provisions, and a couple things in here. Obviously, we've heard that federal student loan payments have been suspended, and there's no interest or penalties during that time period. Kind of an aside, as I realized, I've had a few business owners that work with the SBA, and their loan payments on their business loans too have been suspended, which is kind of an interesting thing that I never knew was a benefit of having a government insured loan. In addition to student loans, also business loans don't have to pay their interest, which has been a big thing for some of our clients. On the charitable side, we've seen they put in a little provision that allows for up to a $300 cash contribution, a deduction, basically what we would have called an above the line deduction for folks that maybe don't itemize now that the standard deduction is so high. So that's been a significant thing for people that are just, in the spirit of giving, helping out charitable organizations. And they've also been tweaking the phase out limitations for individuals that are big donators, where they run into a limitation based on their taxable income of where the contributions aren't fully deductible. They've actually removed that for 2020, which helps out a lot of people where they were significant contributions that were potentially not all deductible. One thing I did read that's not on the slide is I think there's some limitations on that if you have a donor advised fund, which a lot of our folks have been using these days, which is like a personal fund that you use to make charitable donations into. I don't think the removal of these limitations applies if you're contributing to your own family's donor advised fund as part of the charitable giving strategy. But still some pretty significant things that they're trying to do just to help folks, minimize their taxes.
So that covers like the main stuff. There's a lot of other details in the CARES Act, and before we kind of wrap up, I wanted to make sure, with Scott's expertise here on the tax side, if you guys have any questions related to taxes or anything else that's popped up through the happy hour, I'd love for you guys to jump on and ask any questions while we have you.
Scott, Ruth Ann Rossiter here. You had just mentioned the potential charitable deduction of $300 per person over and above what would be the standard deduction for 2020. Yes.
Yeah. If you were not itemizing, you could still get a benefit for donating to a charity.
Okay. Is that okay? We are a couple. Could that be 600? And is it limited to 300?
I think it's just limited to 300 from my understanding on that. So it's not a significant amount, but I think it's just a fixed amount.
And that would be per couple or per joint?
I think it's per tax return.
Per tax return. Okay, thank you.
Got it.
Whoops, Bill has another.
This relates to travel and bankruptcy. And if I were, I'm currently in a situation, keep an eye on TripMate for declaring bankruptcy.
Mm-hmm.
Because I'm suspect that I'm 2 periods over what their standard time is.
Yeah. Yep.
That may or may not be.
For what it's worth, those policies of for any reason, all of a sudden it's got to be tied into the pandemic corona situation,
yeah,
or else you're tough luck.
Yeah.
Mm-hmm.
Yep. Good
Okay.
point.
End of subject.
Thanks, Bill. All right, what else you guys got out there? Any questions?
Yeah, Scott, Rob Lane here. Thanks for your time and intel today. I was curious from a practical standpoint, as folks that may have tax returns in the system, for your business, how are things going in terms of the flow of work? If someone watched this today and all of a sudden saw an opportunity, when's going to be the best time to reach out to their tax person to try and ask them to do work for them? Are you guys just slammed right now, or are you trying to get work in?
That's a good question. Our firm, even though we're what I would call a smaller firm, we were pretty heavy on the tech side. So, if you would have asked me 6 months ago, would your people all be working remotely? I would have been like, nah, no way. But to flip the switch and go to a more remote environment wasn't a big deal for us. So it's kind of crazy. We just had our staff meeting on Tuesday, and I was actually going through, because we track everything. We're accountants, so we're obsessed with statistics and all that kind of stuff. So I had the April numbers because we closed out through the end of April. And it was interesting, our staff's hours and our billings and all that stuff, nothing was really way out of whack. So for us, if you asked me that question, I would say, it'd be a great time to talk to us if you had, if you hadn't filed or you needed to get something finished, because in a way we're remote, but it doesn't feel all that much different other than I don't have nice clients like Dr. Block and Dell coming to my office anymore. But it's really not that much different. So, but every company's, I think, been affected in different ways. We've just been lucky. We were always kind of on the front end of the technology, and we wanted to be set up to be able to have a more remote workforce because we have, people with young children and things like that. But I have heard that some smaller firms have suffered a bunch, and larger firms that have different types of services and work, travel and do things all over the country. It's a little different for them too.
Thank you.
Yeah.
Well, any other last questions here? All right. Well, with that, let's kind of wrap up for the evening. Appreciate you all being here. From the questions and different things that we've heard about, Scott and I both have been, taking a lot of questions from clients, talking to a lot of clients, asking us if, making sure they're not making critical mistakes or looking for opportunities. We've heard questions on both sides this evening, and just wanted to make sure you guys were aware. Obviously, Scott and I would be happy to provide the ability to do what we call like a stress test. So look at your overall individual situation. So whether you're clients of mine, clients of Scott's, doing a stress test, just make sure you're doing everything you can right now, given the circumstances that we're in, to be in a good position. So I just popped up an email you could send to if you were interested in going through something like that with us. But really today was more about providing good information, being available, answering questions for you guys today, and just excited that you guys jumped on with us, spent your evening with us. I am going to be continuing our Konvergent series in the next couple of weeks. I'll be doing one on education, just as an interesting, fallout from the coronavirus, just what's happening with college, and what people's choices are becoming out of that, and whether they're going to traditional college or not, and the concerns around that. So I'll be doing another happy hour sometime in the next few weeks on that. So stay tuned. But other than that, just want to thank you all for joining us. Scott, thank you for coming on and inviting a few of your clients as well. Happy to meet all of you, and just looking forward to talking with all of you guys soon. Stay safe, stay healthy, and just feel free to reach out anytime with any questions. We're here for you.
Thank you.
Thanks,
Homer. Thanks, Scott.
And
thanks, you guys. Good to see you all.
And I'm going to stop the recording here.